Meghan joins us now for more. Meghan, good morning.
Good morning, John.
Have you seen enough so far to get long the long end?
John, I have been thinking back to the start of my career at the markets group of the Federal Reserve. And at the time, we were using buybacks really as just a test operation. And it was something that was used years ago to buy back debt if the U.S. government was running a surplus. We've certainly seen a very notable pivot from the use of that tool really only very sporadically and only in those cases to now and not just being a liquidity provision, but as Stan was talking about this morning, but to control longer term rates and market perception of that. We do think that rather than this being a full-on duration trade where you want to be long 10s or outright long 30s, the better way to do this is by being long 30-year swap spreads or 20s on the fly.
Just explain that and why.
Yes. So when we think about supply dynamics in the market, there's a couple of ways to dimension this. And we can use Fed rules of thumb in terms of QE frameworks, thinking about we've got a stock of debt, we take a certain amount out, we should be able to see yields rally a certain degree. And we can run some of these frameworks. We're just looking at some of these numbers last night. And, certainly when we think about reducing the amount of duration supply, that should bring 10s down. That's usually how policymakers think about this. But what Treasury's doing is very different. It's different in terms of the market signal. This is not changing markets' outlook for Fed policy and actually indirectly maybe supporting a more aggressive Fed. And it also creates a lot of this uncertainty from a fiscal policy perspective. Do investors now actually need to demand more compensation for owning the back end of the curve if this is really just Besant's pet project and is not something that's going to have staying power from the next administration?
If there is an idea that vigilantes are out there, and I guess we could debate whether they are or not, there is some degree of elevated shorts in the CFTC, not crazy by historical standards, but they certainly exist out there. What would it take, and would it be possible for this Treasury Secretary to make enough announcements that it would scare people from shorting the long end of the curve?
So I think there's definitely steps that they can take, Danny. And, when we're thinking about this, right, buybacks are now being used as this tool to reduce longer-term borrowing costs. But what Treasury could do much more directly is cut issuance at the back end of the curve. And this is actually something that the market and we had been writing about over the past year in terms of looking at the fact that the weighted average maturity of Treasury debt outstanding right now is quite long. Treasury does have these tools and the ability to reduce issuance at the back end of the curve. I think that would send a more impactful signal to the market rather than just these buybacks. But the question is this more of a short-lived impact? And will it actually reduce 10-year borrowing costs? And when we think about the impact for the real economy, is it really the 30-year part of the curve that Treasury should care about, the 20-year part of the curve? It really is much more so related to the 10-year part of the curve, which really anchors mortgage rates, more so borrowing costs for the rest of the U.S. economy.
It's a great point. And that brings the question of why use this tactic anyway, and why do it outside of a normal quarterly refunding announcement too? And part of their function is to try to be more reliable. Is there signal in that itself, the timing of this message and the way they approached it?
And I think there so much so is because we're not really looking at a market that was seeing liquidity disruptions. It was much more so, in our view, a reflection of long end, reflecting higher real policy rates, reflecting higher uncertainty around what the Fed's going to do, what the fiscal landscape looks like. This was not disorder. This was not illiquidity. And the fact that we see buybacks, which were a stated tool by Treasury to manage that liquidity, is really taking this into a whole new world for thinking about how Treasury is going to be managing its issuance strategy.
I attempted to ask Mary Daly of the San Francisco Fed what this would mean for Fed policy, and she didn't bite. I imagine you will. How might this influence monetary policy?
So, John, all eyes are going to be on Warsh on Friday. And we know he's going to be talking. He gave us some wishy-washy guidance on that at his last press conference. He may focus on more longer-term, bigger policy themes. He may just kind of directly answer the question that the market wants to know, which is, what is it going to take for you to hike? What are some thresholds for thinking about inflation? How closely are you watching inflation? What metrics do you want to see there play out that would prevent you from hiking rates this year? I think if Warsh sends a signal to the market that he is focused on inflation, is going to be credible in his commitment to bring PCE, core PCE, back down to 2%, that really is going to also help flatten the yield curve. It will take out some of that risk premium that we've seen the long end trade with ever since that July press conference. So we are expecting much more of a strong message from Warsh, a clearer message from Warsh, I should say, that will help anchor those longer-term yields and suggest that we do have this working together between Bessent and Warsh to accomplish those goals.
Do you think they are working together? Because it feels like they're working against each other.
Yeah, I think it's a great question. We don't know, but it almost kind of doesn't really matter, right? We've clearly seen Bessent draw the line here and implement policy and make policy changes, make huge shifts in terms of how the market's thinking about what Treasury's role is. Historically, we've thought about Treasury as regular, predictable issuance strategy, and they're certainly changing that materially. And now it's really going to be on Warsh. Is he going to be sending a message of credibility, which will also help work with Bessent on getting those longer-term borrowing costs down?
Work with me here, though, because there's another way of looking at this. To what extent do lower long-term yields, if Bessent is successful, contribute to easier financial conditions?
And yes, and this is also complicating this fact, right, that Warsh is telling the market, I want to look at longer-term yields to give me information about how I'm setting policy rates. So to your point there is kind of this push-pull between what Warsh is looking at, what Bessent wants to accomplish here, and it does reduce some of that information signal to Warsh in terms of the back end.
I only wish there was a Q&A on Friday, and unfortunately there won't be a Q&A. When they go for that little walk together, they go for a walk and they get to the fence and they stare at the fields. I've been there, I've watched it happen. It's a beautiful view. I understand why they do it. Need Bramo to run over to Kevin as it's happening and just ask him.
With Tom Keene in tow, yelling questions.
TK's not going to keep up.
Yeah, I think you're right on that.
Get over there with a microphone.
Lisa's a fast runner. I believe in her. I think she could do that.
Very
I think she
fast.
could get it done.
Very, very fast. Meghan, it's good to see you.
Good to see
Thank you. Meghan Swiber there of Bank of America. Our coverage in Jackson Hole kicking off in a few days' time.